leadership shakeup coming to Alphabet, the tech giant announcing that former Eli Lilly CFO Anat Ashkenazi will take over the role as chief financial officer. Alphabet has announced that its current CFO, Ruth Porat, will start her new role as president and chief investment officer next month. For more on what this could signal for the company moving forward, we have Justin Post. He is Bank of America's Securities senior internet technology analyst, and he is joining us live from Bank of America's Global Technology Conference in San Francisco. Thank you so much for being here with us, Justin. Talk to me about your reaction to this news coming out of Alphabet. I know that Google is under your coverage here. Are you surprised by the move, and do you think that it was a good one for them?
Sure. I think, first of all, thanks for having me, Madison. Glad to be here. I think it was clears up an overhang. There's some uncertainty. It's taken longer than people expected to get a CFO. Obviously, someone with deep experience and experience with long product cycles, which I think works well for Google. So the stock's up a little bit this morning. I think not a big overhang on the stock, but clears up some uncertainty. And certainly someone with that kind of deep experience is probably good for the company. So I think that's how the street's taking it and how we're looking at it at this point. Obviously, someone outside of the technology area, so don't know a lot about her track record, whether she's a growth CFO or expense CFO. What is different this time versus when Ruth took over many years ago is the company's already on a good cost trajectory. They just beat last quarter, and part of it was expense upside. And they've been doing small layoffs this year. So the cost focus is already at Google at this point, which we think is a positive for the stock.
All right, Justin, I want to dig into AI with you. Our very own Shauna Smith is at the same conference that you're at, and she's talking to some folks, including the Nutanix CEO, who told her that there is a risk of an AI bubble. Now, in looking at my Bank of America notes that I love to read, I took a look at a chart that showcased the kind of NASDAQ versus S&P 500 performance over the past several decades here, and it indicates that there was a larger spread between the NASDAQ and the S&P in the early aughts versus today. That spread is a little bit tighter now. To what extent do you think that we are in two eras that are similar or disparate here when it comes to the concern about a potential tech bubble happening again?
Sure. It's very interesting. I've been through maybe 3 of these transitions in my career. Certainly we had the internet build out in the 90s and then all the content that rode on that. Then we had the mobile build out with the device proliferation and all the content around that. And this time we have the AI technology, and we can certainly get into the spend that's going on ahead of the content and services. But overall, these have been really positive transitions for the internet space and tech in general. And that's how we think about AI at this point. So a lot of build, a lot of CapEx driving the hardware companies. And I think you'll see really interesting services and advertising technology on top of that over the next 5 years. So we see it as a positive. As far as valuations, which I think was the crux of your question, they're not unusual if you look at large cap tech versus 10-year history. So we don't think we're in a bubble for large cap, at least on the internet side at this point. And if you look at the valuations of companies like Meta or Google, which is Alphabet now, or Amazon, not unusual versus history at this point.
Well, Justin, you mentioned CapEx, and as you know too well, all CapEx is not created equal when it comes to things AI. What should investors be looking at to indicate which CapEx on AI is useful for R&D and future potential gains versus just throwing spaghetti and money at the wall?
Sure, it is interesting, and it is a risk that there could be overbuild. I think each company is making a smart individual decision. But in aggregate, are they spending too much is certainly a risk for the companies. A lot of the capacity is on GPUs, and we think, there could be a little bit of overbuild, but over a 5-year period, they will find usage for the GPUs. I do think there will be an advertising and content explosion around AI, and they'll figure out ways to use it. You could have a little bit of upfront build as a modest risk. When we look at the depreciation expense coming through from all this CapEx build, we think we have it in the models. And as long as the top line growth is there and they cut back on employees and other expenses, which we're seeing across the space, we think they can manage the extra depreciation that's coming through over the next few years.